Stag Industrial stock, ticker symbol STAG, a monthly paying dividend stock. Stag Industrial is trading sideways year to date, which is quite a difference with the overall market, in this case the S&P 500, which is up 7.5%. From a dividend point of view, things look pretty interesting with dividend yields sitting at 4.47% and 11 years of dividend increases. But the real reason why people love this stock is because of the monthly dividends, of course. But does this mean that Stag Industrial stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Stag Industrial does. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Stag Industrial do? Stag Industrial is a real estate investment trust focused on the acquisition and operation of industrial properties throughout the United States. The company's portfolio consists of 562 buildings in 41 states, with approximately 111.7 million rentable square feet. If we dive in the most recent earnings report, we see that Stag reported $0.17 net income per share, versus 0.5 last year, which is of course a big decrease. But more importantly, Stag reported a 0.55 core FFO per share versus 0.51 last year, an increase of 7.8% year over year, which is pretty decent. To me, the FFO is very important since REITs use FFO to pay out the dividends. With dividends sitting around $0.36 for the recent quarter, and this is also roughly the same number for the upcoming quarter, dividends are covered very well, so this comforts me a lot. NOI was reported at 130 million, an increase of 13.7%, which also looks pretty nice, but it's lower than the 17.3% full year result, which is something to keep your eye on. The same store cash NOI increased 4.5%, which is also pretty decent. Another important number is the occupancy rate, which is sitting at 99%. Of course, a really good number. With 574 tenants, they also look very well diversified. The 2022 cash NOI growth is sitting at 17%, which we checked in a second ago. And it's the same story with the 17.2% FFO growth. Stag Industrial acquired 26 buildings in 2022, which is also pretty nice. A number that I'm paying more attention to as of lately is the debt to EBITDA. It's sitting at 5.2, which is a decent number for a REIT. I prefer a range of 5 to 6.5, so this looks really good to me. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Stag Industrial is a 5.97 billion market cap company. PE ratio isn't a fair metric to use with REITs, so we are focusing on the price to FFO, which sits at 14.73, indicating that it could be undervalued based on this number. Later in this video I will show you my 3 price targets for Stag Industrial, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 657 billion, and in this graph we see that revenue went up in the long run. It's really steady and consistent, which is something that I really like, especially with REITs. Margins are going up in the long run, but most recently they decreased a bit. This is something to keep your eye on. EPS is also going up in the long run, and it has to be said that for a REIT it looks pretty good. Analysis expect EPS to decrease quite a bit in 2023, but in 2024 it's expected to increase again at mid-single digits. Revenue is expected to stay flat in 2023, but in 2024 it's expected to increase also at mid-single digits. Return on assets is sitting at 2.6%, which is below my 10% minimum. And it's the same story with the return on equity. These numbers are not looking that great. The most important number here, return on invested capital, is sitting at 2.3%, which is also a really low number. But I like the current number versus the 5-year average. It has increased a bit, so that comforts me a lot. Current ratio is at 1.45, which is a great number in my opinion for a REIT. Historically it also looks pretty good. Total debt is sitting at 2.5 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at 98 million, so this doesn't look that good. However, keep in mind that REITs issue a lot of new debt to grow the business. Nevertheless, it's still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares and do acquisitions. And in here we see that free cash flow is going up in the long run, but it's not really steady and consistent all the time. Again, this is very common for REITs. Another thing that is interesting are the shares outstanding. It's going up quite a lot in the long run. Usually this is not a good sign, but REITs issue new shares to raise capital and grow the business. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 4.47%, which is a really good number. Annual payout is at $1.47 and payout ratio is at 66% and not the 146% which is displayed here. This is because REITs use FFO to pay out the dividends. The 5-year growth rate is at 0.73%, which is a low number of course, but dividend yield is already at 4.47%, so it's not that bad. On top of that, they grew the dividends for 11 years in a row, which is also pretty impressive. And the real reason why people love Stag Industrial is because of the monthly dividends. Overall, a great looking dividend scorecard, but how about the historical returns? I decided to compare Stag Industrial with the overall market, in this case the S&P 500. Next to that I added some competitors, Americold, ticker symbol COLD and LXP. On the 5-year chart we see that Stag returned 74% including dividends, beating the S&P 500 which returned 71%. Both COLD and LXP underperformed Stag and the S&P 500 by a decent margin. On the 1-year chart it looks pretty interesting, with Stag Industrial returning minus 16%, which is of course a big drop. The S&P 500 returned minus 6%, and COLD was the only stock having a positive return. But on the 6-month chart things look pretty different again. Stag Industrial returned 25%, beating all other stocks in this list by a big margin. On the 1-month chart we see that Stag Industrial had a 5% return, while the S&P 500 did best with 6% return. So bottom line, Stag Industrial has beaten some competitors and the S&P 500 on the 5-year chart, but also most recently. But how about some fundamentals compared to these other companies? We see that there is a difference in terms of market cap, enterprise value and employees. Price to free cash flow is significantly lower at Stag and LXP versus COLD, so they are the winner here. Revenue growth year over year is the highest at Stag Industrial, and so is the 5-year compound annual growth rate. Net income compound annual growth rate is also the highest at Stag Industrial. Stag and LXP have the highest gross profit margin and the net income margin is the highest at LXP. The free cash flow margin and return on total capital is again the highest at Stag. All companies have quite some debt compared to the cash position, and to me there's no big winner here. The last thing that I want to check are the dividends. Dividend yield is the highest at LXP, but the dividend growth rate is the highest at Stag, sitting at 0.73%. Stag also have the most consecutive years of dividend increases. Overall, I think Stag Industrial looks like the better company compared to the other companies in this list. Revenue growth, free cash flow and net income are growing at high numbers, and dividends are also very nice. But how about the future? Is Stag Industrial stock a buy at current prices? Well, let's check the price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6%, 8% and 10%, since I think they will increase the revenue at lower numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 27, 28 and 29%, For the free cash flow margin I'm filling in 45, 47 and 49. Since this is a REIT, I don't pay attention to the PE ratio, but I will have to fill it in, so I'm putting in 20. For the price of free cash flow I'm filling in 17, 18 and 19. My desired annual return is 15% since I want to build in a higher margin of safety. Usually I fill in 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now Stag Industrial is at $32. I hit analyze and we only see one green number. We have a low price target of $23 and again I'm only focusing on the discounted cash flow value and not the PE ratio. We have a mid price target of $29 and we have a high price target of $36. To me the mid to high price target is the most justified here, so that means a range of $29 to $36, indicating that Stag Industrial could be undervalued right now. My final conclusion on this stock is that I really like the business and the future outlook. The focus on industrial properties is something that will stay here for a longer period of time. It does worry me a little bit that analysts expect only a 5% revenue growth in the coming years, but in my opinion they will grow at higher numbers. The thing that I really like is that it's a very steady and consistent company that really knows how to grow the business. I just love the monthly dividends, and whenever the price drops a little bit, I'm buying this stock to increase my monthly dividends. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.